Do you own a professional corporation and you're trying to figure out how you should pay yourself? Salary, bonuses, dividends? If that's a question you have, then stick around. We're going to talk about it. Now, the first question you may have is, what's the impact of making a wrong decision? The impact of making a wrong decision is that it could cost you thousands of dollars. And quite frankly, depending on the revenue of your corporation and your personal income, it could cost you millions. So it's definitely an important topic. Generally speaking, what are the three ways to get paid? You have salary, traditional employment. I think most people are familiar with that because most times people have worked some type of a job, have some type of a paycheck before they have their professional corporation. Then we have dividends, which may be newer once you have a corporation because you're probably not familiar with it beforehand. And this is just corporate distributions, and that's reported on the T5. And for some organizations, you have director fees as a compensation for board duties reported on the T4. Now, let's start off with the simplest one. It's the salary. Well, from a corporation standpoint, the huge benefit in taking a salary is that reduces your corporation taxable income dollar for dollar. That means if the corporation makes $300,000 that year, you pay yourself $100,000. The corporation taxable income for that year becomes $200,000, and you will have $100,000 in salary. Another benefit for salary, especially for those looking for security, is that you have contributions to CPP. For each paycheck, a certain amount is taken from that paycheck that goes towards CPP, which ultimately in the long run creates a guaranteed income stream in retirement. And those payments come to you later on from the government. And a lot of people like that because there's certain security they could look towards regardless of how the market performs. Another benefit is that every dollar of salary creates RSP contribution up to a certain threshold, which I don't want to get into because depending on when you watch this video, the thresholds may vary. But just know that it creates this RSP contribution room that you could then take part of that salary that you have received, contribute to an RSP, which then lowers your personal income. So if you have $100,000, you contribute $5,000 to RSP. Your income now goes from $100,000 to $95,000. That $5,000 that you put in RSP goes tax deferred until it's withdrawn or until it converts to a RIF and the minimum amount is taken out. So that is a huge benefit for those who want to personally create this RSP, have it put aside as part of your personal plan for retirement. So, a lot of times people who look to salaries are looking for personal security. What about dividends? Well, the first thing with dividends is that it doesn't come with a payroll headache. So what do I mean by that? Well, with dividends, you eliminate that administrative burden of remittances or preparation or payroll compliance that comes with a salary. And having had that before, it can be a bit of a pain, and there's a cost, and sometimes it doesn't always work out the way you want it to, and back and forth in exchanges and paperwork, and quite frankly, sometimes feels like a distraction, right? Dividends, you could determine how much you're going to pull. You could determine how much you're going to pull, and that amount that you pull, you communicate it to your bookkeeper, your accountant, and they made note of that, so you don't have those, payroll headaches. But here's the thing. As much of a benefit that is, you don't get the RSP rooms, and you don't get the CPP contributions, right? And because there's no CPP contributions and also no EI deductions, you keep more of what you earn without mandatory payroll contributions eaten into your take-home pay. So definitely, you get to keep more cash, and quite frankly, dividends are taxed at a lower rate than salary. So there's this added advantage. So there's tax efficiency, and dollar for dollar, you may walk away with more with dividends. And then you also have the benefit of paying back any amount that you owe the corporation. So it's perfect for repaying amounts borrowed from the corporation without triggering income inclusion. You can just have the dividends offset that amount. So definitely here, I think overall, when you look at dividends, a lot of times people are looking at dividends because of flexibility and tax efficiency. Now let's talk about bonuses, which is, lined with salaries. Most times the people are using bonuses is strategic. It's strategic because once you get over $500,000, small business limit at the time of this video, what happens is the tax rate for the corporation goes up. So for example, in Ontario today, which is about just approximately 12%, and you go over that, and you're a little bit over 20% once you go over that $500,000 mark. And so you may be strategic in shifting that income to the shareholder, which is used strategically. And what you're doing here is you're trying to optimize between your personal and your corporate tax rate. So essentially, in many instances, I've seen bonuses being used to reduce corporate taxable income at year end. But big caveat, the bonus must be paid within 179 days of your corporation's year end to be deductible in that year. If you miss this deadline, deductions then moves to the following year, which may have messed up all the plans that you have. Now let's talk about director fees. It's often an overlooked strategy. No, director doesn't need to be a shareholder. It's also great for family income splitting, right? Because a family member can get paid if they're serving as a director. But remember, real duties are required. What does that mean? The person must perform actual director responsibilities and duties. And the amount that's paid has to be reasonable. Compensation must be for reasonable services. So you can't just use your spouse or a family member to be a director just to distribute cash and to be, to lower your taxes. No, this person must have the skill set. They must work reasonable hours. They must demonstrate that they are qualified for the position and what they're doing is reasonable, right? So that's something that's often overlooked, but it's a great way. Now, let's revisit salary versus dividends, which is the constant tension that that comes about. I'll talk about generally, and again, generally, your situation may vary, depending on your circumstances. Speak with your professionals to make sure that you're making the right decision. Salaries win when you want to maximize RSP contribution and retirement savings, right? So that's number one. Another thing is when you want to build CPP credits and you're looking for a guaranteed retirement income, that's where you're going to contemplate CPP. So you're going to contemplate a salary. If you also want to reduce corporate taxable income, salary is a great way to do that because, as we said before, it reduces it dollar by dollar. Another thing is, generally, this is a values conversation because for some individuals, they say, you know what, I know I could pay less taxes with dividends, but quite frankly, I am interested in building that security. Sometimes I feel like even with a business, I have this uncertainty. I want to know that I have this long-term financial security from a retirement standpoint. And this is where salary comes into play because the CPP benefits there. And you have the RSP contribution. So a lot of people, look to that and strong benefits there. Now let's talk about dividends. When do most folks look to dividends? Well, if you want CPP free income without payroll deductions and quite frankly keeping more in your pocket, dividends is often used. If you want administrative simplicity and don't want to pay for everything that comes with payroll, dividends will also be a choice. Now, if you have extra surplus cash that you want to take from the corporation, well, that's also a huge benefit that you could consider in terms of looking towards the dividends, right? Now, often what I see is a mixture of salaries and dividends, right? It doesn't have to be one or the other, because if you have maximized your CPP contributions and you maximize your RSP benefits, both of those have thresholds, and you still want more income, but you know what? You want to be tax efficient in how you receive that income. That's where, dividends play a huge part, a huge benefit. So you maximize your CPP and RSP benefits. So it's strategic to pull a certain amount from salary, a certain amount of dividends. And this is why working with a financial planner is really important, because you want to see what is the right balance. And quite frankly, some years it may be different, right? Depending on how your corporation is doing, depending on your personal circumstances, you may decide differently in terms of dividends. What you take, how much you take, what's the mix, what's not the right mix. And so this is something to consider. So this is a general conversation there. Now, let's talk about the compensation strategy matrix, as I call it. And I'm boiling these down to one-liners, but again, I strongly recommend that you speak with a professional to look at your particular situation to determine what works for you. When we talk about salary, most people pull salary to build retirement, right? Because it's not always the most tax efficient way to receive income from your corporation. But they want to build RSP room, they want CPP benefits, and they want that long-term security. They look for flexibility. That's when they go to dividends, because this is a way to extract profits simply without payroll complexity. And again, sometimes what you do is a mixture of both salary and dividends, right? So you get a bit of long-term security and you also have the benefit of the flexibility. Bonuses is often a strategy that you use to reset corporate income and optimize tax bracket, especially once you get to $500,000. And director fees is an opportunity for income splitting, but then again, remember that those folks have to have a real contribution, provide real value to your corporation. Now, your pay structure is your tax plan, right? Well, not your complete tax plan, but it is part of your tax plan. And it's certainly something that you should consider and not just, think about only when the deadline's looming. It's something that I think you should do proactively, because ultimately it's not only a short-term decision, it's a long-term decision. So even saving taxes today may be great, but may affect you in your long-term planning. So it's something that you should sit with your accountant, with your financial planner, with your tax lawyer, whatever professionals you have, and figure out what that right plan is, what that right mix is, and how you should pay yourself. Hopefully this was helpful, and I look forward to providing you with more value in the next video. Take care.